Hello and welcome to our channel. Today we will speak about an interesting topic for savvy investors. Dividend investing is a strategy where you invest in companies that distribute dividends to their shareholders. Dividends are essentially a portion of a company's earnings directly paid out to its shareholders. They are typically given as cash payments, though sometimes they might be in the form of additional shares of the company. Dividends are generally paid out on a regular basis. It could be monthly, quarterly, semi-annually, or annually. The frequency of the payout depends on the company's dividend policy. What beginners should know. As a beginner, there are a few key things you should know about dividend investing. First, not all companies pay dividends. Typically, well-established companies with a history of stable earnings are more likely to pay dividends. These are often companies in sectors such as utilities, real estate, and consumer goods. Next, it's important to understand the concept of dividend yield. This is the annual dividend payment divided by the stock's current market price. The yield gives you a good idea of the return you can expect from the dividend alone. Another critical aspect to understand is the power of compounding. Reinvesting your dividends by buying more shares can significantly increase your investment over time. This is what we call compounding, earning interest on your interest. Finally, remember that while dividends can provide a steady stream of income, they are not guaranteed. Companies can and do cut their dividends, particularly when earnings are under pressure. So, it's crucial to diversify your investments and not rely solely on dividends for your returns. With these basics in mind, let's now delve into our main topic for today: 3 promising dividend stocks to watch. Today, we'll take a close look at 3 promising stocks that, despite current market fluctuations, have the potential to deliver strong returns for their stakeholders. They are Realty Income, Walgreens Boots Alliance, and Verizon Communications. Let's examine why these stocks draw attention and examine their pros and cons. But before that, it is wise to mention that this is not a financial advice, but just our opinion about stocks we follow. So, always do your own due diligence carefully. Investing doesn't start with complex strategies but with mastering the basics and building a strong financial foundation. Realty Income. Realty Income, aka the monthly dividend company, has been investing in people and places for over 5 decades to deliver dependable monthly dividends that increase over time. As an S&P 500 company and member of the S&P 500 Dividend Aristocrats Index, Realty Income owns roughly 12,200 properties that are located in 49 states and Puerto Rico. These properties are leased to 250 tenants from 47 industries, making the company a diverse and stable investment option. With 637 consecutive monthly dividends on its shares of common stock throughout the 54-year and operating history and a compound average annual total shareholder return of 14.2%, Realty Income has proven to be a reliable and profitable choice for investors. Realty Income, as a well-regarded REIT, offers an enticing dividend yield creeping towards 6.3% versus 2.3% in the industry. Despite its solid business model and strong balance sheet, Realty Income has seen its value drop due to the ascent in interest rates affecting REITs industry-wide. Although still experiencing downward pressure, Realty Income may reveal itself as a generational buying opportunity. The fact that it has weathered past downturns, maintained an impressive occupancy rate of 99%, and operates a diversified commercial property portfolio, suggests potential for long-term recovery. While there's still some volatility in the short term, the company is resilient and has the potential for a good comeback. However, keep in mind, the ideal time to invest might be around 2024 according to some analysts, as rates are expected to stabilize around that period. Financial facts about the company. According to Stockrover, the company has a great margin of safety score of 48%, a value score of 74 and a PE ratio of 37. Next on our radar is the pharmacy giant Walgreens Boots Alliance. The company is a trusted and innovative retail pharmacy with over 13,000 locations across the US, Europe, and Latin America. The firm is dedicated to shaping the future of healthcare by providing access to a wide range of health services, dispensing medicines, and offering high-quality health and beauty products through its retail drugstores and digital platforms. With a strong presence in 9 countries, WBA is also committed to sustainable and inclusive practices, making it a leading index component of the Dow Jones Sustainability Indices. Despite challenges arising from its merger and executive leadership changes, the company commands a significant presence in the US and the UK. It diversifies beyond retail to healthcare for growth. With increasing pharmacy sales, market share gains in Boots, and new ventures in healthcare segments, the company is promising. Forecasted challenges are yet to be profitable healthcare venture, inflation and weaker consumer sentiment. Nonetheless, impressively, it hasn't missed a dividend payout in 91 years, making it a dividend aristocrat. Key financial facts about Walgreens. According to Stockrover, our primary reference among others, the company does have a great margin of safety score of 55%, some financial analysts give it a 70%, a value score of 59 and a price-to-sales ratio of 0.1. The P/E ratio is negative due to earnings. The third element on our watch list is the renowned telecommunications company Verizon. Verizon Communications dominates the U.S. wireless carrier market, serving a massive customer base of 92 million postpaid and 22 million prepaid phone users. The company's wireless segment constitutes the majority of its service revenue and operating income, while its fixed-line offerings cover millions of homes and businesses in the Northeast. Through its Verizon consumer and business groups, the company provides a diverse range of telecommunications services and products to customers worldwide, including wireless and wireline communications, data, video, corporate networking, and IoT services. With its extensive fiber optic network and wireless infrastructure, Verizon Communications is a major player in the modern era of connectivity. The stock has experienced some recent turbulence, which, believe it or not, may represent a great opportunity for passive income investors. The company managed to cover its dividend with free cash flow in the second quarter, indicating that its dividends payout appears sustainable. Verizon's broadband division has seen strong growth, with total connections rising 16% year-over-year in the second quarter. However, growth in its postpaid phone services has been slower due to intense competition. But it's compensating for it by raising prices. Verizon's substantial long-term debt is a concern, but the company's reaffirmed free cash flow guidance and recent dividend increase sends a strong signal that it is committed to financial stability and rewarding its shareholders. Key financial metrics. According to Stockrover, the company has a great margin of safety score of 48%, a value score of 74 and a P/E ratio of 37. So there we go, Realty Income, Walgreens Boots Alliance, and Verizon Communications. These 3 stocks have unique opportunities and challenges, but all worth keeping an eye on. Remember always to conduct your own research and consider your financial goals when investing. Don't forget to subscribe to our channel and give this video a thumbs up if you found it valuable. By doing so, you'll stay updated with our latest insights and strategies.